The next couple sections, folks, insurance has about 6 slides. That's what's next. I'm going to hit on the big nitty gritty stuff. And then we wrap up this section with landlord tenant and property management. I will tell you, just as a precursor to getting there, that I'm not going to spend a whole lot of time on the general things in landlord tenant and property management. Why? Because I would argue that a lot of that section is common sense stuff. If you really think about who the parties are, you really think about what the obligations are, there's a lot that's common sense stuff, but there will be more specifics just so you kind of know where the rest of the night is going to flow. Now, insurance, we've talked about several different times throughout this class. We've talked about 3 different types of insurance for that matter. Hazard or homeowner's insurance, title insurance, mortgage insurance, right? 3 different types. Now, this is talking about hazard or homeowner's insurance. That's what we're talking about here. The other ones have homes in the, deed and title transfer section and, of course, the financing section. So we are talking about insurance policies that protect your house. And as I stated, we've already talked about some of the big pieces of the insurance section. So we're going to spend just mere minutes in this section. First and foremost, understand that there are certain usual covered events in a standard homeowner's insurance policy. Believe it or not, it includes things like fire and lightning and windstorms and glass breakage, explosions, riots, things of that nature. Okay. One of the more testable aspects is being able to differentiate between certain types of policies. Now, I want you to think way, 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 way back, and some of you may or may not remember this. I told you that there was a very specific type of insurance policy needed for condominiums. Anybody remember what that was? There you go, Brad. HO6. Okay. Homeowners insurance policies are identified by the letters HO, homeowners, and a number. And so the most common homeowners insurance policy is the minimum coverage required by a lender is your HO3. You definitely need to know the HO3 and the HO6. HO3 is the minimum coverage required by a lender. HO6 is a condominium policy. Now, there is one that's not on this list that you may get questions on in some of the quiz material. It is called an HO2. An HO2 is basically a step down from the HO3. And I want you to understand the difference. An HO2 is what we call a named perils policy, meaning it only covers the things that are named. That's different from an HO3 because an HO3, while also sometimes referred to, and this is kind of the tricky part, the HO3 is sometimes referred to as a named perils policy as well. It's really more technically a named exemptions policy. In other words, an HO3 covers everything but certain things, and an HO2 covers only these named certain things. Potentially, yeah. Donna says HO2, like jewelry, for example, it could be that it is named to cover certain aspects like jewelry or things of that nature. It could be, that they're only going to cover fire, they're only going to cover wind, but they're not going to cover anything else. There's a lot of different ways it could be used, but it is only covering what is named on the policy, nothing else. HO3 is basically covering the usual events except what's named. So that's the big difference. And of course, the renter's policy is an HO4. That is covering personal property only. The difference between the HO4 and the HO6, literally only personal property on the HO4. HO6 actually covers like exclusive fixtures. You could replace flooring. It could replace toilets and sinks and, things of that nature as well, dealing with a condominium. Now, one of the other things that I briefly mentioned, and I kind of decided that when I talked about it, we hadn't discussed it yet, and that's because it's technically here. When we're dealing with insurance, there is what we call a CLUE report. Stands for Comprehensive Loss and Underwriting Exchange. Folks, this is the reason why when you get in a car accident, your insurance goes up. If you get a speeding ticket, your insurance goes up. There is a report on all of you folks right here, right now. But just like there is a report on us as people, there is also a report on real estate, properties. And so the more things on a report, the harder it is to insure, or sometimes it's even uninsurable. And just like, you know, the Credit Reporting Act says that you can go and get your credit report and see how people are judging you based on your credit, you are allowed to look up your Clue report as well and see, you know, anything on your personal Clue report, and or insurance companies can look it up for properties. And we kind of talked about this being a big part of due diligence, making sure that we could get adequate and or affordable insurance on a property in the midst of looking for a home. Now, I'm going to point out this last one because this is sometimes a very testable aspect of insurance as well. There really isn't supposed to be a whole lot of test questions on insurance, but some of the ones I've seen are kind of rough. So insurance companies will insure, but sometimes are a little more apprehensive to insure second homes. And the reason being, no math with insurance. Yeah. If you've got a fully furnished home, but it is not your primary residence, insurance will cover that because it's furnished and it's a place you can go, which means you're traveling there. But if the property is completely vacant, meaning empty, they don't like to cover, aka they won't cover, and or they'll drop you for coverage, because a home that's empty is a much higher liability because there's nobody there monitoring it. There's nobody there to call if it catches on fire, if it leaks, if it floods. So vacant, completely empty properties, not insurable typically. And then of course, unoccupied, meaning it's set up to live in, but you're not living there. You can get insurance, but sometimes they charge you more because it is still a slightly higher risk. Bree says, how would they know if it was furnished or vacant? They're going to ask you, are you living there? Do you travel there? Is it vacant? You know, they ask you when you get that insurance policy. And insurance companies do drive-bys. They are not above going and looking inside your window. I'm not going to say it's a smart idea, but they drive by the houses all the time. And of course, if they find out and you lied to them, that's called insurance fraud. So one of the other things that's very testable from insurance, we already talked about in the contract section. If we're negotiating a buyer possession before closing or a seller possession after closing kind of thing, we got to make sure we have the adequate insurance for whoever the tenant is, getting renter's insurance at the appropriate time. Of course, we want to also advise the sellers. God, if I could ever just get this tickle on my throat. That they need to maintain insurance through closing. Be careful. You don't ever want to pick that they would terminate at closing. That's not a thing. You want the insurance through closing, because if closing gets delayed, you do not want to ever accidentally not have homeowners insurance. That's a big thing to understand. So in fact, you don't even need to schedule it to cancel, you know, until after the deed has been recorded. And a lot of times it happens automatically when everybody's notified. Other big thing that you need to know from the insurance section, as I said, there's not a whole lot. A lot of this stuff is just pretty straightforward. Flood insurance, folks, is a separate policy that is not included even in the HO3. So you would need a separate flood insurance policy. The other thing that I'll caution you on, and I've told you this once before already, you have to understand that you could easily screw up a test question if you don't remember or realize you are not required to have insurance. If you own your house outright, you're not required to have insurance. Only if you have a loan are you going to be required to have insurance. And then when we're dealing with you have a loan on the property, if any portion of the property is located in a floodplain as designated by FEMA, the Federal Emergency Management Administration, they are going to require you to have flood insurance. So, not required to have flood insurance all the time, but if any part of your property is located in a floodplain and you have a loan, then you're probably going to have flood insurance. One last note on flood insurance. And once again, I mean, nothing too crazy here. Some of this is straightforward as well. So the National Flood Insurance Act of 1968. What that really created was what's called the NFIP, the National Flood Insurance Program. And so there are some properties that are federally mandated to have insurance. Not all, but some, where the government says you have to have insurance because of the location in it. And the whole purpose of that is by kind of requiring more people to have the insurance, then it kind of subsidizes it and makes it more affordable, because we'll never be smart enough to stop buying properties that flood because the water's too pretty. Let's just call it what it is. And of course, understand that.
Hey, Seth, I got a question like that with insurance. So, like, you know how all of those houses down and it's like on the coast of NC?
Yeah, like
They say,
Rodanthe
like,
that are falling into the water.
yeah. So, how would they go about doing something like that?
Those properties all have flood insurance on them. The funny thing about those, Sergio, is, and this is really stupid, they all have flood insurance on them. They're all going to be covered, but the insurance companies will not proactively pay out on them. They are literally requiring them to fall into the ocean before they will pay out. How stupid is that? Nobody will do anything to stop it. Nobody will pay out anything before. So they are not getting a dime of insurance money until their house falls into the ocean and contaminates it.
That's dumb. Never mind. I can't speak.
Yeah, it's something, isn't it? Yeah, it's something. Mm-hmm.
Yeah, because I have one of my, at my old job, one of the ladies there, she would flood a lot, and she's always doing renovations to her home, and they had to, whatever stilts they were on, they had to redo the stilts and move the house higher and all this stuff. And I'm like, you're living in a nightmare just to say you're living on the water. Like, why?
Yeah, why? That's exactly right. I don't know. I told you we'll never stop. I know. So of course, floodplain is a material fact. We would have to disclose that as real estate brokers. Okay, that'd be a requirement. One other clarification, in case you had ever heard this terminology, a lot of people get this confused. If you've ever heard the term about the 100-year floodplain, folks, that is not an area that floods once every 100 years. That is a physical impossibility to estimate that. That's not what it means. Something that's located in the 100-year floodplain means it has a 1% chance of the water is equaling or exceeding the map elevation in a given year. Okay, not gonna flood once every 100 years. It's 1% chance every year that the waters will come to, the map elevation level or higher. That's what that means. And as I said, that was the insurance section. Short, sweet, simple.